So this video is going to be a little bit different than my regular topic market analysis for the cryptocurrency markets. And in this video, I'm going to be talking more about the stock market and financial markets and how to profit from them when you see the big market sell-offs. As I record this, the market was down significantly today. The Dow Jones was down 800 points, the NASDAQ over 300 points, and just pretty decent sized drops across the board, culminating what was already a little bit of a sell-off that started a few days ago. So while this presentation is going to focus primarily on stocks and mostly US stock markets, the concepts are going to be pretty similar for other markets and really for many financial instruments. And so I use these same techniques on things like cryptocurrency trading and other things such as Forex when you're taking the downside on the downtrends. But I want to focus primarily on the stock market. And this is really as a response to a lot of the questions I get regarding how to do these type of things, as well as in my private group, we have a stock channel. And there's been some recent questions because we've been talking about the stock market potentially topping for a couple of weeks now, and we're starting to see it. And so I think there is certainly some opportunities to be had from that perspective. So before we get started, of course, very quickly, this presentation does not constitute financial advice. I'm telling you things that I do, some of my opinions, some of my approaches. I am not a financial advisor, and this is merely my opinion. This is for educational purposes only. All the charts and the trades and the figures I show you will be for example purposes only. And most importantly, keep in mind that I use these strategies for short-term trading. I don't use this for any type of long-term holds or anything like that. Generally, when I am taking advantage of sell-offs in the market, it's very quick and short-term. So by short-term, I mean either day trading or swing trading, right? I'm not holding any of these type of trades or positions for months at a time, for example. And so just keep that in mind. These are just really my thoughts. This is really just to kind of get you going on the track of thinking about these things, considering them, and really exploring them further in detail, because while this video is going to cover a few different things, each one rightly could be its own course, and certainly there's books written on each one individually, and you can really get in depth. And so I'm not going to pretend that this is a comprehensive video or a course or anything along those lines. Really just want to kind of expose you guys to some ideas and to kind of get you thinking along these ways, and just prime you a little bit so that you can do some more research and find one or two of these that you potentially like, and then kind of dig down further in that train of thought there. And so to summarize, if you don't want to watch the whole video, I'm going to basically talk about three potential strategies. There are a lot of ways to capitalize on a stock market sell-off that go beyond these three strategies, but for newer traders, for those that are not looking to get too complicated, these are kind of the three main areas that I would be looking at. And that's going to be selling stocks short, working with options and different options strategies, and using exchange traded funds or ETFs. Now, before we get started, you're going to hear very conflicting things in the financial mainstream media, as is always the case, right? And when you look at stock market tops, the tops are generally a process, right? We've been in this very long-term, very extended bull market that has long surpassed most historical standards of the average length of a bull market. If you look at the economic numbers, everything looks great. If you look at the unemployment numbers, they're at historic lows, but that's always the way it happens. If you look at stocks individually, right, they top well before a lot of these earnings reports start coming out and showing the bad news. Usually there's some sell-off because stock markets, and these type of financial instruments are forward pricing mechanism, and they tend to predict kind of going forward what's going to happen a few months out. And so just keep that in mind, right? You're going to hear a lot of the pundits on this mainstream television saying, oh, buy this dip, and this is an opportunity, and that sort of thing, and oh, the economics are still good, or earnings are great, why is everything crashing, this makes no sense. And because generally they have a bias for investors to be invested and stay long, right? So if you look at things like mutual funds, if you look at institutional investors, they have to be invested. And so really the only option they have is kind of getting defensive, moving into more defensive sectors and that sort of thing. Whereas as an individual investor, we have the luxury and the option of either just getting out of the way, going to cash, or if you want to, even capitalizing on the downside movements and trading on the way down. So that's what I'm going to really be talking about, is how to capitalize on that downside movement. I'm going to go over these three options, these three kind of main areas, and then we'll look at some chart examples at the end and talk about specific strategies by which you can look to enter in some of these areas. So let's get to it. So the first one is shorting stocks, right? And this can be a little confusing to understand at first because generally investors and traders have a upward bias, right? We want to buy something low and we want to sell it when price increases. But this is really just the reverse of doing that. And so going short is when a trader borrows stock from the broker so that they can sell it on the open market with the expectation of buying them back at a lower price. And so to really just simplify that and to illustrate that, if you expect the price to drop and to drift lower, then you sell at some point by opening a short position, right? So your broker will let you sell shares that you don't own. And the plan is that you would buy them back at a lower price and thereby pocket the difference in terms of the spread between what your sell was and what your buy was. And so when you sell to open, what happens in the background is you get a credit. So if you sell a share of a stock that you expect to drop, let's say for example's sake, you sell this stock for $100, then your account is credited $100. But keep in mind, you owe that stock back. So you eventually have to buy it back and return it. And so let's say the stock drops to $90. And so you buy it back, buy to close. So you effectively close your position. And the difference, of course, subtracting any margin requirements and borrowing costs and commissions, the difference would be $10. And so you sold it at 100, you bought it back at 90, and the difference is that $10, and that's your profit essentially. So that's really basically what shorting stocks is. You just sell them at one price and you buy them back at a lower price. And obviously, if the stock goes up after you sell it, then you have to buy back at a higher price, and that's when you incur a loss. So it's basically just the inverse of when you go long, right? You buy something at the low end and you sell it hopefully at a higher price, but if you end up selling it at a lower price, then that is your loss. And so that's shorting in a nutshell. And it can get a little bit of a bad rap sometimes because people say, oh, you shouldn't short, there's unlimited risk because what if the stock goes to the moon and you got to buy it back, you could be ruined. And technically those are valid points. That's always a possibility. For example, if you are short a stock and it suddenly is a buyout candidate and some company comes out and says, hey, we're going to buy the stock for, some 20% premium or something, then you're out of luck, right? You got to buy it back at this higher premium. You have short squeezes, those sort of things that people can run into. So theoretically, yes, your risk is unlimited, but for the vast majority of the time, especially day trading, when I sell short, I treat it just like any other trade, right? If I'm going long, I have a stop position where if the trade goes against me, I get out of the way. You can do the same thing with this short, right? If you're selling something short, you can put a stop loss, which is a buy to close. And so if the price moves above a certain price, you just get out of the trade. And so from a trading perspective, it's really no different. You do the same disciplines, the same risk management principles, stop loss scenarios, those type of things. And so you just have to manage your risk at the end of the day. And so shorting stocks shouldn't be this big, scary thing, this unconventional thing. It's actually quite common, and it's relatively easy to do nowadays on the trading platforms that are available to the average investor. So some quick shorting pros and cons, right? Obviously, the benefits are you get to capitalize on market panics. When the market is selling off, you get to be part of that action to the upside. So, for example, today when the Dow Jones was down 800 points and some of these ETFs were down huge, it was a very profitable day from a trading perspective on my part, just because I had positioned myself to capitalize on some potential downside movement. I didn't expect it to be this dramatic, but I was already looking at some potential entry points, and so I'll share some of those with you guys. But the other thing that I can't say I like about shorting, because it's market panics, but there is, to be honest with you, shorting, I tend to like it a little bit more in the sense because the movements are usually quick when they happen, as we saw today. And that's because fear is a much stronger emotion than greed. And the markets can fall on their own weight, as they say. And that's just because, for a market to go up, you got to have that greed. You got to have the buyers coming in. You got to have new buyers willing to push the price higher because the expectation is that prices are going to keep going up. And so they kind of move the market up. But you've seen when you have those panics, right? The drops are fast and they're sharp and they're quick. And that's because you get fear and everybody runs for the exits, and it's just a selling on top of selling. Plus, you have the added side of there's no more buyers, right? The new buyers are kind of just stepping aside and saying, I'm going to wait and maybe buy at a better price. And so you have this scenario where the market just falls for lack of buyers, plus the added selling pressure. And so you can have those quick sell-offs. It's the whole take the stairs up and the elevators down phrase, right? And we've seen it for those that are trading crypto, right? You get those big moves down that just in a single day will erase 2 weeks worth of upside price action. And it's very similar with stock panics. And so that is why I tend to like them a little bit from that perspective, because I can trade for a fewer amount of days, shorter amount of time frame, and make just as much as I would have on the long end had I been in a trade for a couple of weeks, right? So just something that I like to do from that perspective. Obviously, there's limited profit potential when you're shorting a stock. If you're looking to go down on the stock, you're looking for that price of the stock to drop a few percent, 10%, 20%. If you're long on a stock, you can stay long for theoretically ever, right? And the stock could go up 100%, 200%, 300%, right? You can have huge upside potential when you're going long on a stock versus when you're going short. The most that it could go down is to zero, and most aren't going to go to zero. You're just looking to capitalize on that quick leg down, that corrective action. So theoretically unlimited risk because the upside potential on the stock is unlimited in theory, and the downside, the most it could go to zero. So that's one of the cons. The other one is margin requirements. You have to have a certain account privileges to be able to short. Sometimes there is minimum dollar requirements on an account, so it may not be accessible to everybody, as well as additional costs, because this is technically you're borrowing a stock and there's margin costs associated with that, and that will vary depending on the stock. Most very liquid names are not going to be very expensive, but for example, Tilray, the cannabis stock recently was just going parabolic, but it was a low float stock and people wanted to short it, but they couldn't. So the cost of shorting it, if you could get your broker to borrow shares to you, the cost of shorting it was just outrageously high that it even makes sense to go short on that stock. So it's not suitable for low float stocks, and it's not suitable for low volume illiquid names, right? So just keep that in mind. It's much more dangerous if you're trying to short very low float, very low volume names. So you want to do it only for those stocks that are very liquid, got a lot of trading volume, and are easy to short. The next strategy would be using options. So options, in my opinion, is a little bit more of an advanced strategy, right? So shorting, it's basically the inverse of buying, right? So you follow the trend, you can go on the way down. With options, it's a little bit more advanced because now you have multiple variables involved. And so for those that are not really familiar with options, very quickly, what are options? Options are basically contracts, right? They're contracts to be able to buy or sell a stock. And there's two types of stock options. The first one is called call options, right? So if you buy a call, you have the option, not the obligation, but you have the option to buy a stock at a specific price. And so with call options, you want the stock to go higher because you can buy it at a lower price if your option price is lower than the stock is trading at. And the other side of that is put options. And so put options are the right or the option to sell a stock at a specific price. And so in this case, the reason you would want a put option is because you're expecting the price to go down. Let's say you own some shares of a stock and you want to protect your position, then you can buy a put option. So if the stock value drops, you can still sell at that higher price because you have an option to sell at that price. So that's really the two main types. There's different things that play into the option pricing strategies. When you look at an option, you have to consider the strike price, which means what is the contract that you're buying. And so as a very easy example, if I were buying a stock that today was trading for $100, I may buy a call option that says, I can buy this for $100, or I could buy this for $110. And if in the future, if my option is still open and the stock is trading for $150, well, I can either sell the option for the value difference, or I can exercise the option and buy that stock for $100 or $120, even though it's currently selling for $150. And so that's really the difference, right? So when you buy an option, you buy a strike price. And there's three different strike price terminologies. There's at the money, which is basically what's the currently traded price. And then there's in the money, which is below for a call option and above for a put option, the current price. And then there's out of the money, which is the flip side. And so in the example I just gave, I would be buying call options that are out of the money. If I bought a $120 call option and today was trading for $100, then it's out of the money by $20, right? So those options are going to be less expensive than in the money options, because in the money options already have intrinsic value, right? The option is already worth something because it's already profitable. The strike price is below the currently trading price. The other thing to consider is expiration dates. Now, you can buy options for various months of the year, and you can even go out further, but generally speaking, the further out an option goes, the more expensive it's going to be, because you have more time to decide whether you want to exercise that. You have more time to stay in the option to buy or sell a particular stock. So options that are going to expire in 2 weeks are going to cost much less than options that are going to expire in 2 months. And so that plays a factor into the cost of the option. And third is volatility. And so this is an implied volatility measure, right? So when markets are flat and when markets are not really moving that much and they're moving slowly, the implied volatility of the option is going to be small. And so that portion of the total contract cost is going to be much smaller percent of the total option. In days like today, where volatility just spikes, when you have the Dow Jones dropping $800, for example, the cost of put options spike, the premium to buy those spike because of the increased volatility, right? Because now there's a panic. So it's kind of like insurance. Think of it that way. Insurance is going to be much less expensive before you need it, right? So if you're buying health insurance, for example, it's going to cost less if you're healthy versus if you need health insurance after you get sick. Or if you buy hurricane insurance, and let's say your city has never seen a hurricane ever in its history, but you buy hurricane insurance, it's going to be very inexpensive. But if suddenly you get 2 or 3 or 4 hurricanes year after year after year, hurricane insurance is going to go through the roof, right? So that's the same with volatility. It's just priced into the option, and so you have to factor that in. So for example, today would not be a good day to buy put options. In fact, today was a good day to take profits on put options because the volatility spiked so much that it just commanded a heavy premium for so many of these put options. There's other factors that go into the pricing of options, such as interest rates and dividends and all that, but these are really the big three that make up the vast majority of what it costs to buy an option. So just some key terms. Option chain is really that table of all the different options that you could buy: put options, call options, in the money, out of the money, the different strike price, the different expiration months. And so these are just terminologies that you should look into. If you're not familiar with options, this is where you want to start. Kind of get familiar with these, look at some examples, and then go from there. Before you actually start looking at option strategies, you need to understand some of the basics, right? Calls, puts, strike price, in the money, out of the money, all that stuff. So some option strategies very quickly. I'm going to go very high level, not going to get into a lot of details, just some things to consider and to do some more research into. But at the top of a market, when it looks like things are petering out, but there's not really a panic yet, there's not really the crash, you can look at doing some call credit spreads or bear call spreads. And that's really when you're selling one and taking a credit, and you're a little bit of a hedge because you're selling one option and you're buying another one, but you're taking the difference there. So there's a little bit of a hedging type of thing. You can do covered calls where if you own a particular stock and you don't think it's going to go much higher, you can actually sell options for prices above what you own it at. And the intention there is the options will expire worthless, and you basically keep the premium, the cost of those options that somebody had to spend to buy those options. And so at the top of the market, that's one way to look at it. If things look like they're starting to top out, then you may consider buying some just basic long put options, meaning, hey, I think the price will be lower in 4 months, and so I'm going to buy a put option for that. So the thing with these type of strategies, though, is especially if you only have like a long put, you're not hedged or anything, it's just a simple put option, is you have to consider the time factor, because even if prices drop just a little bit, if they take too long to drop, your option will actually lower itself in value, because there's that time value component. Remember, there's the intrinsic value, there's the time value, and then there's the volatility. And so if it starts to get closer and closer to the expiration date, the value of that option really starts to drop. And so even if prices do start to come down a little bit, now you have to make up for that lost time value. So that's just something to keep in mind. You really want to start trying to time it a little bit better and catch the movement just before it gets going, right? If you're going to be sitting tight for a while and you think it's going to drop but you're not sure when, then maybe another option such as going short or using an ETF would be a better alternative than buying an option, because an option can get expensive at that point. And then once things really get moving, there's a break, you've seen the top in place, there's the panics, there's other options you can play. You can do a long put spread or a bear put spread where you're selling a couple of puts in the money, out of the money, that sort of thing. And there's really, there's just a huge number of different option strategies, and they can get pretty complex, and they have these fancy names, and you don't really need to get that in-depth and complicated to really benefit from a stock market pullback or a crash, or even just an individual stock going down in value. You can do it very simply with some of these kind of basic option strategies. You don't really need to get into all the fancy stuff. I know a lot of people that really enjoy that, and I'm not knocking it, but if you wanted to capitalize on the downward movement, this is one way to do it. I do a little bit more research into some of these specific strategies and see if something that would fit for you. But the pros and cons with options, pricing can be complex because there's multiple variables involved, right? You got to get the direction right, whether you're going long or short, right? Call or put. Then you got to get the price right. What strike price do you pick? Do you buy an at the money and out of the money? And if you buy out of the money, how far out of the money? And then you got time. Okay, once you determine the direction and the price of the option you want, do you buy this month's contract, next week's contract, or do I buy something 6 months out and pay a premium for that, right? So there's so many variables, which that's what makes it tricky and makes it a little bit more complicated, especially for newer traders who are just trying to figure out how options work. It could be a little bit intimidating at first. So just some things, there's some complexities to keep in mind. The other thing is pricing on options fluctuates wildly, especially during these volatile days, right? If things are very volatile and prices are moving up and down quickly, your option value may swing back and forth so much just within the trading day. You may be down big in the morning and then up big in the afternoon and vice versa, and it may finish the day flat, right? So options can certainly fluctuate significantly during big volatility periods, and premiums spike during these high volatile markets. The good thing is they can be very creative, they can be fun in a ways, and you can really structure option strategies to hedge, and you can limit your losses. You may be limiting your profits, but there's a couple of option strategies where your upside may not be huge, but it's almost very little downside because of the way it was structured. So there's just a lot of really neat ways to do it. But for the sake of this discussion, right, how do you profit from stock market crashes, from stocks, individual stocks going down? Then look at some of the options strategies that I mentioned in the previous slide there as ways to get started. And finally, last but not least, is ETFs, right? Exchange traded funds. And specifically in the context of the topic of this discussion, inverse ETFs, right? So for major indices or for various sectors. And so an exchange traded fund, for those that are not familiar, they trade very similar to a stock, right? So there's a ticker symbol and you buy it or you sell it just like a stock. Many ETFs, you can buy options on them or you can even short them, right? So they're very similar to a stock from that perspective, but they are derivatives, meaning they track the price of something else. And so here on the examples, on the first couple of columns and rows there, I have some ETF symbol examples. So the S&P 500, one of the most popular ETFs, is the SPY, right? The SPY, and that essentially tracks the S&P 500 index. There's another way to do it. You can buy S&P futures, E-mini futures, that sort of thing, but the SPY is just a very accessible ETF that just about anybody could buy, just like they would buy any other stock. There are also leveraged versions of these ETFs. And so if you wanted to buy the S&P 500 ETF, but that was leveraged, for example, a couple of examples here are UPRO, for example, is a 3x bull leverage, meaning if the S&P goes up 1%, this one should go up 3%. And then on the downside, right, the SDS, for example, is a 3x bear ETF. And so if the S&P drops 4%, this thing will go up 12%. And so you can really magnify the movements of an index using some of these leveraged ETFs. And I like to use them for day trading and short-term trading. I do not recommend them for long-term holds because there's some fees involved, there's some slippage involved with the up and down movements, and they're just not as efficient once you look at them over a longer period of time. But for short-term trading and for the strategies that I'm talking about today, I like to use leveraged ETFs to kind of magnify some of those moves. The one I've been trading here in recent days are the IWM ETFs, right? The Russell 2000. And so my two that I've been capitalizing on is TNA and TZA more specifically. And TZA is a 3x leveraged bearish ETF. And so as the Russell 2000 index is dropping, which is the small caps, then the TZA is going up significantly. And we'll look at the charts here shortly. You can also get ETFs for specific sectors, right? So for example, the financial sector is the XLF. And I like to track a lot of these ETFs just to see what certain sectors are doing and how they're performing, but you can also trade the ETFs directly. And then you can do leveraged ones, right? Like the FAS or the SKF. Another good example, popular one that I like to trade is the GDX, which is the gold stocks. You can do the GDXJ, which is the junior gold stocks. And then the leveraged versions of those, the nuggets and the dust, are the 3x bull and the 3x bear. And so here's a few other symbols, right? The SMH, the semiconductors, FXI, that's China, right? So you can do an ETF for a country specific. The IBB is the biotechs. You can do the home builders, you can do construction, the emerging markets, the XLE is the energy sector, the XLK is technology. And so these are just all various ETFs that you can either short directly, you can buy options on directly, or you can look for the leveraged version, and that's really the strategy that I tend to use when I'm trying to capitalize on these big movements, especially to the downside, and I'll buy the leveraged bearish ETFs on a lot of sectors that I want to trade. And so let's go look at some of these charts, and then we'll look at some specific strategies that I like to use when I believe it's time to start going short. Before we look at the charts real quickly, I forgot here, the ETF pros and cons. The pros, they're simple to understand, right? They're just like trading a stock. You can do the research on them. It's very easy to pull up what the underlying stocks are within that ETF or what the underlying financial instrument is that it tracks, and you can do the research, you can find the fees. So really easy to understand, very accessible. Like I said, you don't need huge margin accounts, you don't need special privileges, you don't need any of that. You can simply buy them on most platforms just like you would for any other stock, right? And of course, I'm referring to those that trade on the New York Stock Exchange or the NASDAQ or US based exchanges. So obviously if you're not in the US or you don't have access to US markets, then this is going to be a challenge, not as accessible to you obviously, but I'm referring to those that have easily accessible access to stocks like Apple or Amazon. You can trade an ETF. Very similar buying stock, but not good for long term due to slippage, due to fees. Won't go too much into detail there, but especially on the leveraged ones, those are usually not instruments that you want to hold for the long term. They're just really good for short-term trading, in my opinion. And some of them are very low volume, right? You may find an ETF in your research and you may say, oh, cool, this is the inverse version of XYZ sector or XYZ country. But then when you actually look at the chart, you see how illiquid it is. It's just not a popular ETF, doesn't trade a lot of volume. And so you want to find high volume popular ETFs I would not attempt to go inverse on a low volume ETF or even short one, right? So that's usually, I focus on kind of the bigger ones, the more highly traded names when I'm looking to do these type of strategies. So those are some of the pros and cons on the ETFs. So here we are looking at the chart of the IWM, which is the Russell 2000 ETF, the small caps. And you can see here it's been selling off, and then today had a very big down day. And you can see just today the Russell 2000 was down 2.72% at the close. And so pretty big down move here from the peak. The Russell 2000 is now down about almost 10%, 9.75%. So if we look at the TZA, which is the inverse version, you can see here direction on small cap bear 3x. And what it does is it's the inverse of the Russell 2000. And so you can see here today, the TZA had a very strong day, right? It was up from the open to the close, 7.8%. So almost 8% just today. And from the exact bottom, right, the TZA now is up about 33%. So really tracking to that other index, right, the Russell 2000, but it's the inverse version. On the flip side, the TNA, which is the 3x bull version of the Russell, is basically the Russell with leverage, right? So you can see here it's down 26% since the top, and when today was down 8%, even though the Russell 2000 was only down 2.75%, right? So it magnified the move 3x. And so whether you're going long or going short, these are handy for a little bit of leverage, but you can see how quickly it can get away from you if you don't manage the trade. So on the short side, these inverse ETFs I like to trade, but they move very quickly and they do gap. So I tend to use them more for day trading as opposed to kind of longer term holds, maybe even swing trading, meaning a couple of days at a time. And certainly into these moves, right, where things get very hectic, there's a little bit of a panic in the markets, I tend to start taking profits into those moves and scaling out, because you can expect a pullback and even a little bit of a bounce in the market. You can see these things pull back pretty decently. So that's a good example of an inverse ETF. I mentioned the gold stocks, right? So you look at the GDX, and this is an index, an ETF that tracks a basket of gold stocks, and you can pull up the prospectus and see the individual names that are made up within this basket. But you can see here, this is the gold stocks, and if you zoom in a little bit here, so if I go to the 1 hour charts on the gold stocks, you can see here from the lows last several hours, this was up about 3% at the peak. And if I wanted to leverage that, I would have bought the nugget, right? So the nugget from the lows was up about 9%. So magnified that 3% times 3. And the flip side there is the dust, right? So the dust had a sell-off as the nugget and the GDX went higher, was down 8.7%. And so I use these as examples. If you wanted to go short, if you thought a specific sector was going to get hit harder than the markets, as opposed to just doing an index, you can find a specific sector and short that, right? Something like the SKF, which is the financials. You can see how illiquid that is, right? So not everything's going to be appropriate. Even though the daily chart looks like it had a big move, the underlying time frame, right, is not as liquid as it looks on some of these names. So you have to kind of look at that from that perspective. Now the XLF, which is the financial sector, very popular. I could have just shorted this directly, right? So I could have shorted an ETF that tracks a sector as opposed to shorting the individual names within that sector, such as Citigroup or JP Morgan or something like that, right? As opposed to picking the individual stock that I want to short, then you can just short the individual sector, or as I mentioned, you can even buy options against individual ETFs. So now that you know the options and you've kind of figured out, okay, I can either short directly, I could look at some options, or I can buy an inverse ETF. How do you know when to start entering it, when to do it? And so let's look at a few strategies that I like to use, different approaches that I take when I think it's time to start shorting. Again, this is not a comprehensive guide. There's multiple strategies, different ways to do it. These are just some of the ones that I like to use. I would recommend a couple of books that would definitely come in handy if you're looking to learn more about selling short, capitalizing on market sell-offs and downdrafts. The first one is How to Make Money Selling Stock Short by William O'Neill and Gil Morales. It's a thin book, a relatively quick read, and it's just chock full of charts, examples, and just the basics of when do you sell stocks short and all that stuff. No fluff, just kind of gets straight to the point. I like that. I would recommend that one first. The second one is How to Take Profits, Cut Losses, and Benefit from Price Declines by Dr. Alexander Elder. I love his work. His books are superb. I really like his style. It just kind of resonates well with me. And he talks more than just charts and strategies in this book. He talks about risk management and psychology and all that good stuff. But he certainly has some examples and some approaches that he takes. And so I would definitely take a look at that one as well. A little bit longer of a book, but still very good. And so I would look at those two in terms of getting started with selling stock short and some strategies that you may want to explore further. So here's one example of a short strategy that I like to use, right? And so in this example, we're looking at Facebook. And let me go to the daily chart here. And so Facebook had been one of the darling stocks, just moving high, was hitting at all-time highs. And then it had earnings. It was talking about some issues because of, various things, but not happy, and just had a massive drop. Facebook overnight gapped down about 20-some% at the open and just had a big break to the downside. Now that is not where I like to go short. At that point, it's just way extended, way overdone. And so when I see a big break like that, I look for a bounce into which I could short. And there's a couple of places I like to look for bounces into. Generally, I like to find them into moving averages. Now you can see on this white line, that's the 50 EMA. Once it breaks below that, that's kind of shortable from my perspective, just because it's below a little bit more of a longer term moving average. But when I start looking to go short, I look into bounces into shorter term moving averages. And so you can use various moving averages. There's no really set rule, but I like to use two moving averages, one shorter and one a little bit longer. In this example, I'm using a 10 EMA and a 22 EMA. You can use a 13 and a 26. You can use a 21. There's just so many different ways you can do it. But if you have to, once the shorter one crosses over and prices start to bounce, see this gap between the two moving averages, right? When it starts to go into there, I start to pay attention. And if it looks like it's going to roll over and start to fade, that's really where I like to short, right? So you get these big breaks and then you get these bounces into these moving averages. And those are my entries, right? And then you see a pullback. Here you get another little bit of a bounce right into that moving average. And it creates a little bit of a bear flag, right? You get these slow bounces and then a relatively quick sell-off right after that. And generally, I will take the first or the second attempt like that. Once you've had 3 or 4 or 5 bounces into those moving averages, it's becoming a little bit more obvious. And I've noticed each sell-off is not as pronounced as some of the others, but certainly this is a trend trading strategy, right? You have this break and you start to bounce into resistance, then it pulls back, you bounce right in. And those are places to look to go short, not on the break of patterns as is commonly misunderstood, right? People will say, oh, once it breaks below, that's when you go short. You tend to like to sell short into bounces because then at that point, you can keep a relatively tight stop, right? You can say, hey, if it breaks above this resistance, then clearly I got in too early and get out of the way. And so that's what I'd be looking to do. So bouncing is into those moving averages, especially when the moving averages are declining, right? You can see the trend is clearly starting to turn, going lower. That's a good place to start looking at it. And the RSI here too, look at how weak it is, right? RSI never bounces back above 60. If it fails to get above 60, it just shows me how bearish it is. In this example, it was very weak, couldn't even get above 50. And so that's another confirmation there that I like to look for. So those are things like the double top or the head and shoulders pattern, right? And those are especially strong when you see them, near new all-time highs, as well as when there's divergence showing up here. And so in this example, right, you have Tesla. Tesla had this very strong rally, and then it put in the top, followed by a pullback, another rally that really started to end, and look at almost exactly at the same point, created a little bit of a double top right there. And you can see that second high RSI, big divergence on the RSI as well as on the MACD. So those type of indicators really signify that that second top was not as strong. And I start looking for the first signals that it's starting to roll over and fail, and that would be my double top entry, and not when it breaks support. By that point, you're a little bit late to the game. Now, that's the classic way to do the double top, is you wait for it to confirm and it breaks support. But if I see those divergences, I'd like to get in as close to the high as possible with a really tight stop. And then when it breaks the double bottom, that's when I get out. And then I look for a secondary entry, right? So in this example, when it breaks the neckline of that double top, you look for a bounce right into that resistance, and then you get another leg down. But you can see that's really the end of the move, right? It's already played out, and then it kind of just goes flat from there. And so those classic patterns, double tops, head and shoulder patterns, I certainly like to take advantage of those, but I like to look for them either before they confirm and get in as near the top as possible, or after they confirm, they break lower, and then I trade them on a bounce into the necklines or resistance levels, and then look for another leg down from there. And finally, the last strategy is the failed breakout attempt with a divergence. And what I look for there is a breakout attempt and then a pullback here. So if we look at the weekly charts of some of these major indexes, right? So the Dow Jones is a classic example, had a breakout to new highs, right? So it made new all-time highs, but as it was breaking out, you can see the RSI and the MACD just had massive bearish divergences in them, right? Just would not confirm the new highs there. And you can see here, it was just not confirming. And so what I look for is I look for that breakout, and as soon as it fails and starts to pull right back in, then that makes for a good short entry, because I then have a very tight stop. I look for a stop just above the most recent high. Look at the NASDAQ, right? It was making these highs. I'm gonna go to the daily chart here. As it was moving along here, you can see the RSI was pulling in, MACD was already rolling over, and even in the bigger picture, if you look at just the recent march up higher over the last couple of months, you know, we've started to see some weakness showing up in some of the indicators there. You can see the MACD is also showing it. And so what I look for again is that attempt into a new high and then a pullback here. Once it breaks below that most recent base, that's the entry. The alternative is you could have gone with the trend line break, which I talked about just earlier, and you could have gone with an entry right there. In both cases, my stop is basically right above the most recent high. So it makes for a relatively tight stop, because this is an aggressive entry. You're getting in a little bit early before it's really starting to roll over, but you have a much tighter stop, a better risk reward entry from that perspective. And the same concept can be applied to individual stocks or individual ETFs. If they start breaking out and then they have that failed breakout and tuck right back in, then those are the places to start looking at initiating some aggressive early entries. Otherwise, you look for that confirmation, you look for a break of these moving averages to the downside, and then you start looking for short entries as they bounce into those moving averages. And so those are the handful of strategies that I use. I mean, there's a lot of different ways to do it, but just kind of big picture, wanted to just share some of those thoughts with you guys. I've been getting a lot of questions about this topic. Hey, you know, the market's going down. What do we do? Should we, you know, how do we capitalize on this? And of course, you can always just sit it out, right? There's that option, just kind of not trading it at all, not even having to worry about it, just kind of staying flat, going in cash, and then waiting for a bottom to show up. Or you can capitalize, especially if it's going to be a little bit more pronounced, a longer term. You know, nobody knows yet, right, if this is just another one of those blips like we saw in January, where it was, you know, a couple of weeks of choppy, volatile action, and then things settled out, and then we marched higher. Or if that's it, right, if that's the end of the bull, and this is going to be more than just a couple of weeks, and it's going to be a couple of months of pronounced downward. There's going to be rallies along the way, absolutely. There will be bounces along the way, but you got to look at the big picture, right? Is the big picture going higher, or is the big picture going short, going lower, and should you be going shorts, right? I mean, there's, in any market environment, there's always names that are going up, and there's always names that are dropping. But you will do best if you swim in the direction of the tide. And so for the last couple of years, the best trades were really going the long end, right? Taking advantage of the stocks that were moving high, looking at IPOs, and things were just moving high or breaking up, and you're swimming with the tide. You know, everything is moving up. There's a lot of bullishness. And so you know, look for options and look for strategies that are working in that direction. And vice versa, if everything looks like it's going to start breaking down and you see the market just starting to stair step its way down, sure, there's always going to be names that are going up, but if the majority of stocks are going down, then you should be predominantly looking for strategies to take advantage of a downtrend and not trying to fight the trend and looking for, trying to guess the bottoms and looking for these long entry points. And so that's what I'm doing. I tend to try to swim in the direction of the tide, swim in the direction of the trend, as they say. And right now we may be entering a period where we have a little bit more extended period of downward movements as opposed to this long bull that we've been in for so long. So hope these ideas helped kind of introduce you to some of these concepts and how to capitalize on potential sell-offs in the markets. There's a lot more to learn along these lines, and so really I wanted to just kind of give you guys a primer, a video with some ideas and some thoughts around the various ways to do it, so that then you can go and research some of these specific instruments or strategies with more detail and figure out ultimately what is best for you and what strategy resonates well with you. So appreciate you guys watching, appreciate the likes and the subscribes as always, and I'll catch you guys in the next one. Take care, everyone.